And then, in preparing ourselves for the next strategy, I want to just introduce some basic things. We started by introducing some indicators. The TDI indicator, we introduced this one. There's another indicator too that I will introduce later, but it's the same as the TDI, so that is not so relevant. So, and then I also introduce something for you guys called the momentum wave. We call it the WT cross, but that is all in preparation for our next strategy. And that next strategy is very good. It's a juicy strategy. However, the pending strategy that we've learned is also very, very good. That is for like the person who just started, who just want to be able to hit the ground running, make some money, and doesn't have much time. They can just use that to make strategy. This one is for someone who is day trading. The next strategy we're going to teach is for someone who is day trading and he wants to take this serious. He wants to make at least 2 to 4% a day on their whatever investments or whatever they have. And so they want to take, and that will be the next strategy. However, for us to go on to those strategies, because we've not had the masterclass to almost like round up the whole session that we started off, I'm just only introducing the tools, the indicators, the things that we use for the next strategy. So that's what I'm trying to do. And then also possibly I'll give some psychological levels for maybe one coin after that. And so when we meet on the 16th, then we'll round up everything and this phase will be over. The class then will possibly be divided into two. Those who have gotten the first strategy and they're moving on to the second strategy. And then those who are new. So those who are new, we have to take them back and then walk them through, which means that I have to start from the beginning, like how to use TradingView, how to navigate your way around TradingView, how to do support and resistance lines. That one I have to just create the notes again and present the information more concisely, because now I have more insight but from these teachings. And then we'll build it up to that 4-2 strategy again for them. But then those who have gone through the 4-2 strategy, they then will be building on additional strategies, because possibly there could be 3 main strategies that we could use. The first strategy is the 4-2, and then the second strategy is the 4-1-1-5. But even that 4-1-1-5, we've changed it now. It is 1-6-4-1, something like that. It's different, and that is very juicy. So that's what we are preparing for. To do that, there's something I believe I might have touched on moving averages, but I want to introduce you to moving averages properly. You know what I mean? Especially in light of the next strategy. So when we talk about moving averages, when we talk about moving averages, let's go and find the definition first. And normally I want to show you things on the fly so that when you want information, you know how you find it. It's not special. Google does a lot of things. So moving averages. I could just go and then find the definition and then you wouldn't know where I got it from. So moving averages is, okay, let's use in trading, and then let's go. So moving averages, which is MA, is a simple technical analysis tool that smooths out price data by creating a constantly updating average price. So yeah, what it is when you look at price very carefully, let's reset this. Yeah, realize the price will go up, come down, go up, go up, go up, come down. It doesn't look smooth. It's like rough edges, rough on the screen. Like it goes up, comes down, goes up, comes down, goes up, comes down. What the moving average tries to do, I think we've done this before though, but I just want to introduce you now. What the moving average tries to do is it tries to smoothen the price. It makes the price all looks a bit smoother, like cleaner. You know what I mean? So for example, if I should turn on one of my moving averages here, let's turn on the 5, and then turn off the price action. You realize that it looks like it's smoother rather than it's rough. You see, so that is what the moving average tries to do. And with the moving averages, you can do the moving averages based on the candlesticks that you're trying to add. For example, if we are in the 1 hour time frame, yeah, and we are in the moving average, let's say this one, we call it the 5 moving average. So we go into, let's say we've opened the moving average. I'll show you how to move it, open it now. And then in this moving average, we say we want the length to be, let's say 5, right? So if we want the length to be 5, what it's doing is, for the candlestick or for this line, it is going to add the 1, 2, 3, 4, 5. You add it, and that gives you a point. And then the previous 5, you add it and gives you a point. The previous 5, you add it and gives you a point. So that makes you, it gives you an average of the 5 candles based on the selection you've picked. For example, imagine we go back into the same moving average and we pick something like 20. Yes, that same way, it adds the last 20 and it gives you a point, last 20 and it gives you a point. But what then happens is the smoothing, you realize that it is not very close to the candlesticks, meaning therefore that the smaller the moving average you add, let's say if you select a 5, as to a 20, you realize that the line lies exactly very closely to the candles than the higher the moving average you choose. So for instance, we have, if we go back here and we say, okay, let's put 3 moving average in it. You realize that it will lie exactly. You see the 3 moving average lies exactly on the candles because we are adding very, very small group of candles to create the line. It's a best fit, that kind of thing. So how do you find the moving average? We've done this before, but I will just introduce again. Indicators, you go to indicators as usual, and then go and take any moving average, right? So when you go in, you find a moving average. You see there are different moving average. You have moving average exponential, and then normal MA. In the previous lesson that we did an introduction about what EMA is, which means exponential moving average, and then a moving average. The exponential moving average, as we were saying, was that puts more weight to the current candles. So for example, if this current candle's length and this current candle's length and that current candle's length, we're looking at the 5, let's say the 5 moving average, right? It means that the calculation will put more weight, which means maybe it will pick this one, multiply by the average price of this one, multiply by maybe 1.5. The average price of this one multiplied by 1.6. The average price of this one multiplied by 1.4. And then so as you go back, the weight that it puts on the candlestick becomes lesser, and that gives you the points. That is for exponential moving averages. And for moving averages, we just take the average price of each candle, and then what it does is it gives you the line. Meaning that when you're looking at EMAs, which is the exponential moving averages, they are more stronger, which means they are more stronger and they are more closer to the current price than the MAs. We also said that the EMAs is normally used for short term or this thing, shorter time frames, and the MAs are used for longer time frames. So for example, what I mean by that is if you want to have the here, the 5 EMA, for example, on this one, you want to have the 5 EMA, it means that it is better to use EMA rather than MA because we are talking about, let's say we've selected an EMA because we're talking about a shorter time frame. So that is that. So then I was talking about how to get the indicators. So you can either get the MA, which is the moving average. Yeah, moving average. Yeah, moving average. Yeah, and then you can just pick any other, right? There's one that I usually like. We call it the MA plus. So MA and then plus like that. Right, the MA plus by this guy. It's called demand. I normally like it because it has colors on it. I've picked it up already, so I'm just going to show you how that looks like. So this is the MA plus. And what the MA plus does is very, very simple. The MA plus changes color. If it realizes the market is going up, it gives you green. If the market is coming down, it gives you red. That gives you an idea how the market is traveling. So for example, with the MA plus, it is the same moving average, right? So let's go into the MA plus settings, right? So it is it's a moving average, as we said. It's a normal moving average. You can it's a simple moving average. You can, with that, you can even come and pick the type of moving average that you want. But we want it to be a simple moving average. Why? Because we are going to be using it for a longer time frame, meaning that the number of candles we wanted to add is a lot. So we want the MA length to be 100. So we are adding 100 candles, and it's giving it the smoothing for 100 candles. So what we will do is, let's say we selected the MA plus. Let me see if I can select it and then show you the settings. A plus by Dman, yeah? Oh God, go back. So, okay, I think I've opened it. Yeah, so that's it. So let me go into MA plus. Now it tells us it's on 30. So we go into the inputs. What we want is MA, that's SMA, simple SMA. So you select SMA. It was on EMA, but I will select simple SMA. And then we come and change the length to 100. Fine. So all it does is it's just falling in place. Let me just take it as the first one. I've got it already there. So this 100, what it does tell you is that it's adding any time frame that you find yourself. We're on the 1 hour time frame. What it's saying is it's adding the 100 candlesticks, and then we'll give you a point. Then it will come and then add the next 100 before the first candle, it gives you a point. Keeps adding, and that creates a line. But what this does is it gives you an idea as to how the market is trending. So for example, we can clearly see that when it started turning red here, the market started coming down. When it started turning red, you could easily see it. That start coming down all the way. When it start turning green here, the market start turning back up. You know what I mean? Start going back up. What therefore is, when you are trading generally with the next strategy, the general concept for trading, and this is where you have to start drawing the first strategy. You have to box it, because this is the average strategy and the rules. The thing is, when you are trading in this market and the market is going down, it is recommended. It is recommended that you trade with a trend. Do you understand? So what I'm saying is, because it is going down, if you get a candlestick confirmation wherever you get them, you trade just down. And then you wait. It comes back again and you trade down. You wait, it comes back again, you trade down. That is the idea, because the market is trending down. That's fine. So the SMA or the MA, the 100 MA, help us to find the general direction of the market. Now, there's another MA that we also use. And this MA or this SMA is the 20 moving average. So for example, you want to find the 20 moving average. You go in here, you just type moving average in the indicators. You pick any moving average. So let's say we pick this one or that one. Simple moving average. Let's take the one out. So we go in, it says input length, we want the 20, okay? Style, you can choose any color style, but in this case, let's choose something like a yellow. Yeah, and then let's make the line a bit thicker. Visibility, you can view it on all time frames. So we have 20 length. Oh, what's length? Oh, sorry. I think, let me reset this. It should have been the SMA length. Reset this. The SMA length should be 20, I think. Did it change? It didn't change. Let me go and find it again. Maybe it might be this one. I think it should be this one. Let me reset it. Reset. And then chart. Chart length. Let's see. We'll find out. Did it change? It didn't change. It's changed. Okay, that's fine. So it should be the length in the chart. Length is 20. This SMA, just ignore it because it's SMA again. So we go into the color, we make it white, or no, we said yellow. We want it to be fancy, so we said yellow. That's fine. We make it like the next level thickness, and then click somewhere on this thing, drop downs, and then okay. So this is what we call the 20 SMA or the MA, the 20 MA. Now, look very carefully. What does this 20 MA do? We know that we are generally going on a downtrend. Yeah, we're generally going on a downtrend. So when we get opportunity, we get this candlestick confirmation, we enter the market, and then we use our psychological level to take profits. So this one, it goes to the first psychological level. It goes down to this one, you take your profit here. Now, we expected it to, this one, it retraces a little bit. It retraces, it didn't get to the 20 SMA, but then you could see this tweezer top here. You go back into the market, you take the money on your on this psychological level, and then it retraces all the way back to the 20 SMA, right? What it is what happens is that the general concept is when price is trending on a downtrend, yeah, and then we see that price has moved, and maybe we've traded this, and we want to go back into the market. We need to wait for the price to come and test the 20 SMA. Please, this one is not the same. I'm just trying to remind you, don't mix this with a 4-2 strategy. This is a different thing. I'm just giving you general orientation for the next one, but I'm just showing you how this SMA works. The 4-2 strategy, we don't use these things. It's just only psychological levels, a walk in the park kind of thing. So it would come, we were saying that when price is trending down, maybe we take a profit on the psychological level. It would come, buy, and test the 20, SMA or the MA before it will continue in the trend. Do you understand? So it came, tested this, and continued in the trend. And then it came, tested it, continued in the trend. Came, tested it, continued in the trend. You see, all the way down here, tested it again, continued in the trend. Tested it. And then this one, it broke through it all the way there, which means that the pattern is likely to change. And then we started trailing halfway down the line, all the way till the point now that you can see that this thing is becoming green, which means that the trend is changing. You see, so, and normally you will realize that the 20 SMA was riding below the 100 SMA. It was just riding below it, very clean and very nice. Riding below it all the way till it became very close to, which means the market is on sideways market. It crossed here. When it crossed there, then it means that it is more like an information to us that the market is about to change in the opposite direction. So all you'll be looking is an opportunity to go back the opposite direction. Now you find the 20 SMA on top of the 100 SMA. When we have this candlestick pattern breaking, like this, like a bullish engulfment, you can go into the trade and trade up almost to a psychological level. But this one, we are talking about psychological level. We are not talking about the 2%. We're talking about psychological levels now. And then it came and retested it, the 20 buying, because now we are in an uptrend. We went to the psychological level. It looks like it's gone through the psychological level. At a point, we'll come and retest it, buying, and it keeps going. That is what seems to be happening now. I've been doing a lot of study on this. So for some time, I've not been trading. I just want us to get the strategy locked down. And this strategy, it's for those who they have the time, they want to take trading seriously. So what then happens is maybe in a day, they want to just make about 3% or 2%. Very simple kind of strategy. All you're waiting is there are ways that you get reminded that the candlesticks are around your area. So when you come and you check on the candlesticks, you go into the trade. For example, today is the 4th. So let's say from the 3rd, that is when we started having the true trend changing. So for example, we're here. Let me put a line there. For example, we're here. All right, we're there. Let me change this thing and make it a fancy color. So like a purple like that. It's not so clear. Let's do it another yellow. Okay, so for example, we're here. We realized that the candlestick broke above the 20 SMA, and then we would have entered the market and tried to go all the way up. This is 3% because you look to the left and see where the candles came to the left, and then you try and take your profit there. This is about 3%. That's yesterday. And then we were here again. You realize that the candlestick gave us a morning star here, right? On the 20 SMA, because it comes to retest the 20 SMA before we go, we just pick it up again and then go to the psychological level. Another 3% today. Do you understand? If you are daring enough, you could have stayed in the market, because there's a way that you will know that the thing is staying in the market. I'll show you. It's an indicator that we use. We are not using the strategies just yet. And if you stayed in the market, you would have started all the way from there when you enter the market. All the way now, you're looking about 5%, but possibly you can go all the way up here to about 7%, because I can see the candle about to go up here and retest this one. You're talking about almost 7% just for one day. You know what I mean? But you need to learn the strategy. The thing is not about the money that you could make. And I keep re-emphasizing that because I've not been trading. Why? Because I want to get the skills set for this strategy very flawless. So you practice and practice and practice and test net. It's not about the money. It's about getting the skills right. Once you become second nature and then you start putting it into practice, it becomes like you're just joking and then you're making the money. Okay, fine. So this is the 20 SMA, right? There's another SMA that I would show you. So it's the same thing, but that one, we call it the 5 SMA. Because this one is the 5, which means the moving averages are very small, we rather would use the EMA because we are calculating very, very short. 5, only 5 candles, only 5 candles, only 5 candles. We are able, excuse me, so we are going to use the EMA. So now, assuming we just go into the, let me see, what's that? 1 minute. So let me close this one. So let me go and get another indicator. So in this case, what we want is the EMA, right? So we have this moving average exponential. So we picked it up. It comes here, go. We want the length to be 5. Do you know what I'm saying? So the length is 5. Let's give the color to be, I don't even know. Let's say red. No, let's not red like that. I want something which will be clearer on the screen so you can see it. All right, let's use this green. Oh, that green. Maybe a bit thick so you can clearly see it. And it's EMA style. So it's EMA, and then give me guys, give me a minute. I want to check where this nice thing comes from. It doesn't look to be from here. All right, that's fine. So that is this green over here. I think let's change it. I want the color to be different, way different. It's closer to the yellow. I don't like it. Yeah, okay, let's put the blue there. Then it's different. All right, so what we can see is for the 5, we are using the EMA. And you see the EMA is very close to the price actions. How do we use the EMA? Do you understand? Because the EMA, the 5 EMA is close to the candlesticks, what then happens is that anytime the candlesticks move away from the EMA, we expect it to come back to it. Anytime they move away from it, we expect it to come back to it. Anytime, look, they move away from it, we expect the candles to come back to it. Like this one is moved away, we expect the next candle to come back to it. And that is what it is. You can almost see it. Let me turn the 2 off, then you can see how it looks. So, what's that one? All right. So look, you can see that anytime let's go back and work this. Expand it. All right. So you see this candlestick moved all the way here. So this one moved away from it. This one started moving closer. This one started moving very closer. It started moving closer. It has to snap back. So anytime candlesticks move away from the 5 EMA, they would have to snap back to it. And then this ones, they will deviate a little bit, bang, they come back. They deviate a little bit, and then they come back. They deviate, and then they come back. You can see it. That is it. So with this, what then do we use it for? We know that if the price moves away from the 5 EMA, you would have to come back to it. And then how do we use it? I'm just going to give you a fair idea of how we do use it. And then that could be a preparation towards our training. Now, let's look at just here where our price started going up. There, just there, where our price started going up, because I cannot, we are not in strategy, so I won't need to teach much. So the candlestick crossed the EMA here, which is a true indicator that it's crossed the psychological level, right? So we would have gone into the trade here, all the way there, right? Now, we know that this candlestick has moved away from the 5 EMA, right? Also, the second concept, we know that whenever price moves away in the uptrend, it has to come and retest the 20 EMA. Do you understand? So the 20 EMA will draw the price back to retest it. At the same time, the 5 EMA is also magnetic for the candles to come back, meaning that we are in an uptrend. Rule number 1, we should only trade in the direction of the trend. What happens, which becomes exceptional, is that there are people who, after they learn the rule number 1, they become very proficient with rule number 1, and they understand how price works after we've gone in the same direction. He knows the price would have to come back and then either test the 20, and the price is drawn to the EMA 5. So, for example, we have this candle, which shows that it's more like a tweezer top. Although we don't have to trade against the trend, we can almost conclude that because we've got a tweezer top and we are away from the 5 EMA, the price will be drawn back. And when the price starts getting drawn back, it is likely it will come and retest the 20 EMA. So rule number 1, we don't have to trade against the trend. But in this case, those who are exceptional, they understand how these rules work. They can trade against the trend by going into the thing here and then coming all the way down to take your profit on the 20 EMA. You see, so then these are like exceptions, or these are like professional ways of trading, whereby you know that, oh, we are going with the trend says up, but we know the rule is that the 5 EMA will draw down this thing, the candlestick to itself, and then we'll have to retest on the 20. So when you see the opportunity, you can trade up and you can trade down. And then once you've traded down, we have something like a morning star here. You go into the trade. When you go into the trade, You go into the trade, buy, you trade again because we have the morning star. This kind of confirms straight to the psychological level. So let's say between this day was the 3rd, that is 3rd of July. And then till now, let's say you close in your trades. Today is 3, 6. Okay, let's say 5 o'clock. You close your thing at 5. So let's put another stick here. Yeah, 5. So from yesterday, what do we have here? When the market is changing, we didn't even trade at all. We're just on the waiting. So let's say we waited yesterday. We've gone into this trade. We made, let's say, 3%. We understood the fact that we can be drawn. We made another 2%, that is 5%. When we had this morning star here, it broke the 20 EMA. We've gone back into the trade. It went up, it came and retested buy. So we had another 3.5. So between, let's say, 2 days, we are looking at about almost 8%. So this is 3. Let me calculate again. This is almost 2, that's 5. And then this is about 3. That is about 8% for 2 days, meaning that you're averaging about 4% a day, which is serious. Okay, so I thought I would just show you this as a preparation for the next strategy. The new people who have just started the course, these people are not going to be doing the new strategy. They need to get the basics, unless of course they're traders already, but they need to get the basics very well. I would make sure, I need to emphasize, because the thing about trading is that trading is, it can be funny, and you need your basics right. There are times even now that I doubt myself, like, oh God, this thing is becoming too much. I was talking to my wife yesterday, it's like, Jesus, I'm going into trades without thinking lately. Because I'm studying, I'm going to trade without thinking, and it looks like it's daunting. So you need to get your basics right before we can look into building on with other strategies. So for the new people, I will recommend that we'll go back and then go through the course and then get them the basic strategy with a 4-2 strategy very well. Those who have advanced on the 16th, we will see. And then we'll see how well they are doing in the testnet with their 4-2 strategy. And then we would introduce the new strategy. I think that's it for today. To end this, let me just give you some psychological levels on the coin that you might be interested to trade. So there's this coin called eGold, electronic gold, to call it eGold. So I'm going to give you the psychological level for eGold. Let me close this thing now. All right. So for eGold, for eGold, let's go to the 4-hour because our 4-2 strategy works with the 4-hour. Okay. So this is eGold. I'm going to give you two different psychological levels. All right. So eGold, it starts from 40 and it goes to 45, 50, 55, 60, 65. What I've done is you can see that there are 2 different colors. I've created 2 different folders for that. So what is happening is for the one with this color, this light green or this thing, cyan color, what it is I've created a folder that is 40, 50, 60, 70, and so on, 80 and so on. And then I put them all into one folder. I call it a psychological level 1. And then I leave that on, and then I create another sequence of lines, which is 45, 55, 65, 75, and so on. And I put them all into another folder, which I call psychological level 2. Sometimes you might not need psychological level 2. Sometimes you do, right? So all I'm just saying is that if you want to look at eGold as part of your portfolio, these are the psychological levels. And that's it for today. If anyone has questions, I'm going to stop the how we call it, the recording, and then we can take questions.